they have laid out a particular, the ecosystem has evolved without they having come out with a roadmap. I don't think they had any precise roadmap. But at the same time, now we are in a situation where now this system which is evolved is firmly taken roots, and we are going to have a lot of fun. Can we start, Amit?
Yeah, sure. Whenever. I'm ready whenever you are, sir.
Yeah. So there are about 26 participants now. And welcome to this SAGE talk. This is a second SAGE talk. First one was about behavioral corporate governance by Star Gopalakrishnan. This is something which is connected, which is to do with the proxy advisors. And what we are saying is that we are here to understand what proxy advisors are, who proxy advisors are, what proxy advisors do, and the emerging landscape, which is going to make proxy advisors principal players in the governance domain. In that context, we have, at this point of time, we have 3 proxy advisors in the country. One is Institutional Investors Advisory Services, India Limited. Then we have Stakeholders Empowerment Services and InGovern. Mr. Amit, we are today extremely privileged to have Mr. Amit Tandon here with us. And may I take a few minutes to introduce the speaker. He is a founder, Institutional Advisory of Institutional Investor Advisory Services Limited, and its managing director since July 2011. In fact, the date of incorporation which I saw was 24th June 2010, if I mistake not, or 11.
2010.
10. Okay, thank you. Before IIAS, Mr. Tandon was the managing director and CEO of Fitch Ratings India from October 2001 to June 2011. Also had oversight over Fitch Ratings Sri Lanka. Prior to joining Fitch, he was in the ICSA group for about 17 years, from 1984 to September 2001, where he rotated through various roles and businesses, including project finance, leasing, and the merchant banking division. His last role with the ICSA group was a set of investment banking at ICSA Securities. Mr. Tandon has been a member of the RBI's Technical Advisory Committee on Money, Foreign Exchange, and Government Securities Markets, a member of one of the working groups convened by Ministry of Corporate Affairs to review comments received on the Companies Act and the Quota Committee on Corporate Governance constituted by SEBI. Amit Tandon studied economics at St. Stephen's College, Delhi, and as an MBA from the Faculty of Management Studies, Delhi, and as an MPhil degree from the University of Cambridge, UK. Extremely delighted to welcome you, Mr. Amit Tandon, and we are eagerly looking forward to your presentation on understanding proxy advisors. Now, before that, for the benefit of the participants who are comfortable with what the legal definition is, I may quote what SEBI, Securities Exchange Board of India, has defined a proxy advisor in its SEBI Research Analysts Regulations 2014 as means any person who provide advice through any means to the institutional investor or shareholder of a company in relation to exercise of their rights in the company, including recommendations on public offer or voting recommendations on agenda items. Now I hand over the mic Amit Tandon for him to make his presentation. We will have a Q&A after he completes the presentation. Over to Mr. Amit Tandon.
Thank you. Thank you very much. I'm actually quite overwhelmed to be in this group because I see there are many people here who I've actually, kind of keep calling up to say that, look, I want some help, I want some advice. So I'm kind of overwhelmed, but nonetheless, I'm happy to be here and talking to all of you about the voting advisory or the proxy advisory business or industry. It's something which I'm very, very passionate about. And what I'll do is I'll kind of break it up into two parts. So, we'll kind of very quickly walk through the environment in which we are operating, and after which I'll kind of, throw it open for any questions which any of you might have on this presentation. So, we were told about, understanding the topic which I was being given to talk about is understanding proxy advisors, the governance guardians. But what I want to focus on a little bit is just put this in the context of, where we are today. And I think this is important because it tells you why suddenly after, our being around for 10 years, we are suddenly kind of, dominating some of the conversation which is taking place. And after that, I'll talk a little bit about, when I talk about IIAS, I'll talk a little bit about our systems and processes and show you some things which might be of interest to you. The first part here is broken up into the three subsections: increased institutional ownership, regulatory push, and advent of proxy advisory firms. And in a sense, the three are interlinked. So I'm not sure whether if one of the legs was missing, how effective the other two would have been. But nonetheless, we were fortunate in as much as all these three have had their role to play over the last 10, 11 years. This is a slide which kind of talks about institutional ownership in the Indian equities over the last 12, between 2010 and 2021. I just focus on a couple of numbers. One is these are the, these three are the institutional ownership, and that number is now at about 34%. From about 23% a decade back, and promoters are 57, were 57 or 58% about 10 years ago, and they're just over 50% today. So what does it mean? The first is we believe that, there are certain features which this ownership structure gives us. First, that there is a generational view of business, which is very different from where we seem to have gone, which is a quarter-to-quarter view of business. Because, you look at some of the older families, they'd kind of said that, okay, we are not looking at business, something which we're going to do today, but, complete something which will survive us for 20 years or 50 years or 100 years. The second feature of our ownership pattern is that, it's a dialogue between two sets of shareholders. And this is important because if you look at what happens in the US model, you've got, these shares are institutionally owned. And therefore, the investors kind of talk to the board, and the board then ensures that the management is doing what the shareholders would desire it to do. As against that, in India, it's a dialogue between two sets of shareholders. So therefore, the issues are completely different. And therefore, what does it mean for our governance parameters? I think I'll just focus on this aspect in terms of that institutional ownership and what it means. So as I said, about 10 years ago, the ownership was about, for every 2.3 shares that the promoters held, the institutional investors held 1 share. Today, the ratios changed. And therefore, for every 1 share that the institutional investors hold, it's 1.5 shares which are held by the promoters. Then if you look at some of these startups which are listing, if you look at what is, some of the changes which are taking place, you find that there are a lot of companies where the promoters don't exist or have a very minuscule holding. It could be something like Zomato, which listed. It could be a company like Z, where the promoters are now down to about 3 or 4%. It could be shares like RBL Bank, or it could be, CDSL, BSE, where there are no promoters, or even when you look at companies like, the HDFC group, which has spawned subsidiaries where for all intents and purposes, they're all institutionally owned because the parent is institutionally owned. Or the same happens when you look at the ICICI group. L&T has got 3 subsidiaries now. So there's this whole change which is taking place in the landscape, and that will have a couple of implications. One big aspect of this, of course, is the fact that it's not unusual to find funds owning more than 5% in a company. So we find that happening for, SBI mutual fund or LIC mutual fund, because of the money which is coming in from the pension, which is kind of steadily going up. But also, if you look at some of the mid caps and small caps, it's not unusual to find that an HDFC or an ICICI own 6, 7, 8% of the company. So what these two things mean is that, look, from relegating the shareholder to saying that, look, I own 57%, you individually own 0.5%, 1/4%, 1%, and therefore I can afford to ignore you. What it means is the fact that you can't afford to ignore the institutional investors, because there are issues on which all institutional investors by and large think in a similar manner, be it dilution, be it ESOPs, be it how they view some related party transactions. I'm not saying it's absolute, there's a convergence in thinking, but the divergence is kind of slowly coming down. And therefore, you have to carry the institutional investors as you move forward. And this has huge implications for the market. A related aspect is that, now that institutional investors own 35% of the equity and you have promoters at 50%, if any investor, large investor, is upset with what is happening in the company and they decide to exit, it means that they cannot do so without the share price getting impacted very severely. So what it means is that investors are much more engaged with companies on governance issues. I may have a different view whether you should expand, you're a textile manufacturer and you should get into auto components, or you're an auto component manufacturer and you should get into, metals and mining. But on governance, there's broad consensus in terms of what happens. So therefore, if I want to continue to remain invested, I don't want to take a big, exit when the share price is falling, I need to kind of engage with companies with regard to what is happening and what we believe as investors to be good corporate behavior. So this is one change which you're going to see in the market. Look, I'm speaking to a very enlightened audience. I'm not going to talk about the second of the two legs, which is, the change in regulations. I'll focus on 4 aspects or 3 aspects. One is, how do we, from our perspective, how do we see all this happening? And I say, just like in telecom, we've gone from from telecom to 2G to 3G, 4G. We've kind of seen this thing happening with regard to regulation. So while in the first 2 phases, we were in the building block, from 2019, the focus was in terms of how do you execute, what happens, a greater focus on some of these aspects. And finally, where we are today is there's a recognition that, look, while the companies are being asked to do something, there are other stakeholders also involved. So therefore, why not get, the board to play a greater role in what is happening in governance, to get the auditors to play a greater role with regard to what is happening in the governance, to get the investors play a far greater role with regard to what's happening in governance. So this is a big change which we are seeing. Just like we are getting into 5G, I'm kind of asked what will happen next. So where we are heading towards is a greater focus on ESG, and you are kind of seeing the building blocks today, and we can talk about a little bit more of this in Q&A. The other is, while you're familiar with all this, I kind of just talk about the framework. It's good to look at these regulations in terms of the G20 OECD principles. India is signatory to the G20. So if we kind of look at how the OECD principles are and what the regulations are, I think what this means is that as there are global changes happening, you should expect to see changes in the Indian market. I'll just talk about one other thing, which is, I'll kind of, which is that, when I think about when I think about the Companies Act 2013, it had a couple of, took a couple of steps which kind of put governance at the forefront. I mean, right from, there are things like definition of independent director and greater focus on RPT, etc., etc. But what they did was they made e-voting mandatory. So we moved from a stage where, you walk, all of us would be familiar with, you walk into a hall, people raise their hand. So whether I own 100 shares or whether I own 1 lakh shares or whether I own, 10 lakh shares, everyone was treated as one shareholder and one vote, one share was one vote. As against now, every share is being counted. The second is they kind of started introducing concepts like majority of minority, which have had a huge impact. So e-voting and the fact that majority of minority have had a big impact. There's another development which I want to focus on, which is stewardship. Stewardship is, how do funds, which is mutual funds, pension funds, insurance companies, AIFs, how do they think about governance and what are they doing to, focus on governance and more broadly ESG? And it's basically saying that, look, it's not your money, you're managing money for a bunch of your unit holders or policy holders. You have a responsibility towards these people, and therefore tell us, how are you assuming or how are you fulfilling your fiduciary responsibilities? So what this slide talks about is the fact that, SEBI kind of asked mutual funds to publish voting policies, publish how they voted on resolutions, ask them to disclose their voting rationale. So these were the building blocks of stewardship. Then the PFRDA asked the pension funds to vote. Then IRDA jumped everyone and asked the insurance companies to adopt a stewardship code, as it was followed by PFRDA and then SEBI. So if you look at all the components in the market, you'll find that all of them have a stewardship code. What is the stewardship code? You're going to hear a lot about it, but this is, have a policy for conflict of interest, which is very critical. Monitor your investee companies, establish guidelines on how and when you will escalate. If you have an issue, how will you talk to the management? When will you talk to the board? When will you, kind of socialize or talk about what your issues are? Have clear policies on voting and disclosure and report on these activities periodically. And I say that, in this whole equation, throw in the proxy advisory firms, and we kind of, study shareholder resolutions, opine on them, talk about what is important. This gets picked up by the media, it gets picked up by some of the investors, and therefore, we've kind of become, in one sense, we also, like the rating agencies are gatekeepers in the debt market, and the boards are supposed to be, and audit companies are supposed to be gatekeepers. In a sense, we've also kind of become gatekeepers of sorts in this whole equation. So what does all this mean? I think I'll just kind of show it in terms of voting participation. We don't have data for insurance companies, but if you go to around 2012, and the way to read this slide is that you've got abstain is the colored one, Against is the dark one, and you've got the for, which is, so if you go back to 2012 and you look at it, about, sorry, I didn't put a number there, but about 90% was abstain and 10% was voting for. And if you kind of contrast it to what has happened today, 11% is abstain, and about 89% of the resolutions are getting voted upon. So we've kind of flipped the mirror on this. FIIs have always been voting. What does all this mean? That resolutions are now getting defeated. I should have gone back to 2014, but after the New Companies Act, but when you kind of look at it, there's some 192 resolutions which have been defeated in the last 5 years. And this year itself, if we look at year to date, there are about 13 resolutions which have been rejected. I'm not saying that rejected is important, but it's just kind of showing you a trend of what is happening, something which you didn't see before the New Companies Act, you're starting to see. And then these are across, whether it's board changes, RPT, ESOPs, remuneration, borrowing, it's across all categories of resolutions. And this is just some color. I've got this number of 192 since 2014 out here. This is a little bit more color. In the interest of time, I'll kind of skip through it. And this is just another way of denoting some of this data. I'll now come to the fact that, people would say that, look, who are you to, how come you've got into the space? Why are you doing it? And talk a little bit about ourselves and some of the products which we have, which enable us to focus on this a little bit more closely. But first is we are regulated by SEBI. And therefore, there is a protocol and there is a process which we need to adhere to. And SEBI kind of periodically comes in and asks us, and we report to them, etc., etc. So that's one aspect. The second thing which I would say is that, since our advent to now, we've looked at over 8,000 shareholder meetings and over 50,000 resolutions. We are now covering about close to 900 companies, which means that this year we would look at about somewhere around 7,000 resolutions. Now, no one in the market is kind of looking at this number of resolutions and focused on this so closely as we are. So we've got, as I say, a pulse on corporate India, as well as a fairly good understanding of what is happening on these. The second thing I'd say is that, look, it's not that we have kind of decided that, I like a company and I don't like a company, or I like an individual and don't like an individual. But these are a part of our voting guidelines, which, this is the one which we've been publishing these from 2013. We kind of put it out in public domain for commentary. If we are going to change any of our regulation, any of our policies, we kind of again put it out in public domain to get feedback. And what I'll do from this year is maybe send it to Sage so that they can circulate it to their members, so that we get a feedback and there is a broader understanding in terms of how are we approaching things and how is it that investors are thinking about it, and what is it that the companies are doing. The second thing I'd like to say is that we go through a committee process, so which includes, looking at the resolution, looking at what other similar resolutions, looking at what has happened in how investors have voted on these resolutions in the past. Get more clarity, look at what the company has disclosed, whether it is on its website, whether it's in the annual report, whether it's a stock exchange filing. We oftentimes also look at, go and visit or dial in to company calls, look at recordings, what have happened, to get clarity. So it's not that we are kind of looking at things in isolation, because what I believe is that resolutions have to be contextual. Now, what we often find is that resolutions are kind of based on what is legally required, rather than giving investors clarity with regard to what the company intends to do. One example of that is, when you look at fundraising, company will say, look, I want to raise equity, I want to issue FCCBs, I want to issue equity, I might do a preferential allotment, I might do a QIP, I might do a rights issue. I can understand that you are wanting to take an enabling resolution. But what we believe is that the explanatory note, you need to say that, look, this is what our target debt equity ratio is. We might be opportunistic, saying that, look, we are borrowing a little bit more because we believe the rates of interest are low, but we will refinance ourselves and reach our target debt equity of 1:1. I think what you saw happen with Siddharth Lal 10 days ago is a good example. The company had no intention of paying him 3%, but they generally said, okay, we are going to pay him up to 3% of the salary. Now, when profits are going up, the investors kind of believe that, look, we can, and in steady state, investors believe that, look, we've got a sense of what is going to happen. But when profits are volatile or coming down, and when sales are coming down, investors are asking, look, is it that the profits are going to fall because they're going to be now, with electric vehicles, all these changes, the company is not going to be able to meet its target numbers, and therefore they're kind of, keeping more margin. This was something which was not communicated adequately enough by the company. So there are enough examples of what this happens. So I kind of said that we kind of look at some of these things and what I'll do is I'll just take 3-4 minutes and just show you a platform which we all kind of use extensively within the company to give you a sense of how we go about it. Just bear with me for a minute. Can you see my screen now?
Yes.
Okay. So this is a database. So, when I said we've looked at, 50,000 resolutions, the number as of this morning is 52,025. We've covered 8,900 meetings, 192 have been defeated, etc. Now, what this tells us is, I'll just kind of look at two different cards, since all of you will kind of understand this. This is classified as per resolution. So if I kind of, So if I kind of, this is, just give me a minute. Let me kind of go back to. So when I kind of go here, I can kind of look at resolution. So if I'm looking at, let's say, for capital reduction, this tells me all the resolutions for capital reduction, which have kind of popped up over a period of time. So you can then go and, look at, okay, what did e-clerk service say, approve. You can actually then go to the notice and download the notice and look at what the specific resolution was there. You have different ways of kind of cutting this data. So you could actually, if you want to look at, let's say, section, so you can say, look, I'm looking at a resolution, which is section 188.1A, 188.1A, 188.1E, and, let me kind of just take all of these. So it tells me all the resolutions which were there for related party transactions. So this is one thing which kind of, and you can actually look at it, which of these were ordinary, which of these were kind of special, which of these were taken in a postal ballot or let's say AGM. So, and which of these kind of got rejected? So you can kind of then, sorry, I'll kind of just say outcome is, so, sorry, I haven't used it for I mean, I haven't, but we can kind of get to what is happening. And you can actually also look at it in terms of companies. So you can say that, look, I want to look at all the resolutions, meetings which, okay, let's say 3M has had. So it kind of tells me everything about 3M going back to 2016. But if I look at, let's say, ICICI Bank, it could go back to as far as 2012. So it's a fantastic repository of what is happening. It also tells me how investors are voting. So if I want to say that, look, how did Aditya Birla Sun Life vote on resolutions, it will tell me how they voted on various resolutions. Let me just go back to that, resolutions defeated, because that was something which is. So yeah, these are the resolutions which were for, okay, I've kind of not saved the resolution category. So these are the borrowing resolutions which kind of got rejected. So you can kind of play around with this. And I'll just kind of very quickly complete my presentation. And then we can throw it open for questions. Okay. So this was just some of the features, but I thought it's much better if I kind of disclose some of the features, what happens, and so that you can just register and log in. You can play around with it for a while if you like. I think you can play around for a week or so. So just like this, we've got a database for compensation. So we've and of course we are looking at how shareholders have voted. So some of those features are there. So if you kind of go back here, it'll tell you each of the why have they voted the way they have. So Aditya Birla Sun Life, if they voted for it, why have they said they're going to be vote for a particular resolution. So it kind of gives you details on about 45, 50, 55 investors, how they're voting on these resolutions. We are also looking at governance scores. This is something which we did with IFC. So in other words, we are putting a number to governance, looking at the OECD G20 framework. And what we find is that it's kind of stood the test of time. So it kind of gives us a sense that what we are doing is correct. And, companies can also and investors can take this to ask us what are the engagement areas with companies. What we also periodically do is look at what are the best practices, share these with companies so that they know what is it that we can do and what is it that we can do a little bit better, be it disclosures, be it responsibilities, equitable treatment, what are some good examples and what are examples which we feel are worth emulating. And finally, I said we are going to be heading towards ESG, and we are kind of working with investors in terms of integrating ESG into their decision-making process. So I'm going to stop short here. I've kind of given you a very quick overview with regard to what we do, how we do things. And I thought, much more of it can come out of a discussion which we have through a Q&A rather than, any specific questions which you have can be answered in a Q&A rather than through this presentation when I kind of talk about what I think you might be interested in hearing. So over to you.
Thank you, Amit, for a very providing deep insights into what proxy advisors are and also about IIAS. In fact, what was very striking was a sort of the ecosystem which developed post 2013 with the introduction of e-voting.
Absolutely.
And I think, if I may say, the defining moment was the Stewardship Code, which mandated the institutional shareholders to not only vote on all resolutions, but also to give their voting rationale.
Yes. Yes.
And if I may add one more, which is going to start on 1st of January 2022, these are all the independent directors. Independent directors will be appointed and reappointed by a special resolution.
That's right.
This, I think, will be the Azadi Ka Amrit Mahotsav. During the course of our 75th year, on 1st of January, we are going to see a totally new revolution in corporate India, where directors' appointment and reappointment is going to require 75%. And from the data which you have just now produced, where institutional shareholders are now 34%, almost close to 34, and the promoters holding on an average is now around 50.
Yeah.
So it will require the nod of the institutional shareholders for every appointment or reappointment, and that is going to be something to be watched very closely. As far as this stewardship code goes, I think, in all fairness, we must also have we will have a program soon on the stewardship code, because now these are large institutional players who are having a say on the governance issues, and their conclusions are by and large based on what the proxy advisories say. So to that extent, but at the same time, they are necessarily obligated to follow the stewardship code. And to that extent, I think a discussion on the stewardship code could be useful to us. Now, I have some questions which have already come. Now, with this presentation which you have given, it's quite overwhelming to know as a company secretary, and I'm sure most of those who are in this profession will be quite flabbergasted to know that you are in the midst of having 52,000 resolutions. And then this is also quite unnerving, is that about 192 resolutions have got rejected, and about 13 in the current year. So now this I believe is also a clarion call for the members of the Institute of Company Secretaries of India. And I think IIAS Adrian, which I believe is for public viewing and sale and whatnot, should be a very useful tool to understand what the expectations are at this point of time from people who really matter. It is one thing to go through the book, and we all have gone through the Ramaya as a guide, but that along with what is expected right now, because the entire landscape is changing, the scenario is changing, and the fact that we need to recognize that there is a change which is happening around us is, I think, is the most important need of the hour. And this is a very, very object lesson for the company secretaries, as you pointed out, about what exactly the resolution, how exactly the resolution should be worded, what information is required to be given in the statements. So these are matters of critical importance and detail for the members of the institute. Having said that, all this, there are some obvious questions which we have got. One is that how do you overcome conflict of interest in the development of your recommendations, in the sense that you are, unlike one of the proxy holders who is is known as a not-for-profit proxy advisors. You have shareholders, and I've gone through the list. They are quite marquee companies, groups. And in that case, how do you overcome this conflict of interest, which may at any point of time enter your arena?
Okay. So let's kind of just give me a minute. I'll just, we can actually look at it in terms of where all are the conflicts of interest, at what level, and which are the areas which kind of will plague conflict of interest. As I see it, there are three primary areas where you could turn around and say there are conflicts of interest. The first is as you said, with regard to our shareholders. The second is the fact that some of our services could be subscribed to by listed companies, and one example is that increasingly when we started operations, none of the insurance companies were listed. Now they're listed and they take our services. Similarly, none of the mutual funds were listed, and they kind of take our services. So we are that is a potential area of conflict. And the third is board memberships. And what we have at all these cases is that, look, we've got a structural mechanism to manage the conflict of interest in all these cases. So, once you're aware of what they are, so let's say with our shareholders, none of them have a seat on the board. And therefore, their influence in that sense is one step removed, that they're kind of calling us up and saying what is going to be happening. The second is we kind of, as and when there is, we've got policies to deal with it. The second is, when we are voting on resolutions, we've again got policies. And if we are deviating from our policy, in our rationale itself, we explain why we are deviating from the policy. The third is the fact that, the process we follow, it's not one person, there's a committee process which goes through, which will determine what will happen. Fourth is the compensation structure. It's flat. It's not that, if we've done as a firm, people are getting bonuses, and therefore, we've got, in a sense, a fixed clientele. And therefore, that's another way of addressing this conflict of interest. Structurally, we've separated the business development from the analytical team. That's another way of doing it. And finally, we are kind of disclosing our conflict of, if there is, we kind of disclose it so that the user says that, okay, this is where it is. Do I take their recommendations at face value? Or do I take it with a pinch of salt, knowing the fact that there is some kind of conflict? What we also do is, at least for our sanity, we kind of keep looking at, we look at some of these, how we voted on someone who's a customer versus someone who's not on a customer. And I would say that, the data stacks up pretty well. Another way of looking at it is, when we, the total cumulative customers we have who have taken our services, be it voting advisory or something else, is about 26. As against a total number of customers of about 866. So as a percentage also, it's really not, changing, moving the needle for me, that I say that, oh, it's very important for me to cater to this customer, and therefore I'm going to do it. So that is how I believe that, through a number of ways, be it our policies, be it our disclosures, be it the structure we've set up for ourselves, be it the fact that we've got voting guidelines, and ensure that we're managing conflicts of interest to the best, in a significant and substantial manner, and in a meaningful manner.
Okay. I also happen to peruse the latest. In fact, probably this what we are having this talk, Sage talks on Proxy Advisors, is the first after the last year's guideline on 1st of September 2020, which contains a host of guidelines from SEBI, regulatory mandates for the proxy advisors.
Yeah, yeah.
So to that extent, I think all those policies, all those committees, they are all in place
Yeah.
as far as IIAS is concerned. So as you mentioned about the structural, the base which you have laid out for overcoming this conflict of interest is probably well laid out. Now there
So
is
let me just add to it just for the benefit of everyone here. We are the only proxy advisory firm globally which sends out our recommendations to the companies before we send them out to the investors. And our reason for doing so is that, look, a lot of what the company is proposing is contextual. And therefore, our experience is that the companies haven't actually always been able to communicate it in a meaningful manner. Sometimes it's because, sometimes it's because they've just done a cut and paste. Sometimes because, there's this disconnect between the company in terms of where the CFO stands versus where the company secretary stands, or it could be for the fact that they believe that, look, the promoters have a large chunk of equity and therefore it really doesn't matter. Or just the other is, as I said, this awareness is a little bit more recent, where you need to be recognizing that you need to be a little bit more transparent in it for your resolutions. Because till I kind of started doing this, my reaction when I got the annual report, and that time it used to come physically, is I kind of threw away the notice and kept the annual report to read. Now it's the other way around. I kind of keep the notice and don't focus on the annual report. But that aside, so it could be there. So we are the only firm which actually then sends it out to investors. We get it back. We then, we go to a committee, come up with recommendations, write out our report, send it to companies, get it, get the feedback, and go back to the committee and take final recommendations. Then we kind of, after which what SEBI's said kicks in, we send the report to the investors and we send it to the company. At this stage, if the company comes to us with a feedback, what we are obliged to do is to, forward their feedback to all the investors. And also if there are any changes in our recommendations. So what we do is we say, look, the company is written to us. Does it mean a change in our recommendations? Does it mean there's no change in our recommendations? Or does it mean there's a change in our write-up and the explanation? And we kind of send it back to all the investors. So that process is also now, we've been doing it from 1st of January. So it's kind of well established. Most companies have an understanding of the second leg. The first leg, as I said, since we are the only proxy advisory firm globally, we encourage companies to continue to engage with us.
okay. So in fact, thanks for this clarification. I also happen to see this guideline circular on 3rd of August, with which you might be familiar with, where SEBI says that proxy advisors shall share the report. So it's almost mandatory as of now with its clients and the company at the same time, which is precisely what you're doing.
So in fact, we are sharing it one step before also, because that was our practice before. As I said, to get better context and make our recommendations more robust.
Okay. And they have also said, but at the same time, they have said, after taking into account the said viewpoint, the proxy advisors may revise the recommendation in the addendum report or issue an addendum to the report with its remarks as considered appropriate, which is what you are saying in terms of after you receive the comments from the this. Now, I have a question, which is, what about this foreign institutional investors? Do they also subscribe to your viewpoint, or do they because they have a different methodology in terms of from whatever I know that they have this custodians, and then who are they engaging with, because their shareholding also is creeping slowly but surely to a higher level.
Yeah. So there, again, the way I see it is, while we call ourselves proxy advisory firms, the fact is we are voting advisory firms. We don't hold the proxies because, at least in the domestic market, everyone votes themselves. Globally, what had happened was, and at least for the smaller investors, they kind of effectively gave this responsibility to the global firms, IISS and Glassloos, who used to vote on their behalf. Having said so, the big change which we are seeing in the last 5-7 years is that all the large investors and some of the more progressive, smaller ones have their own stewardship teams, which are focused on governance and help them decide how they want to vote. Now, my experience here is that, where they have a large holding, and different firms are defining it differently, they will have their in-house teams look at it, where they have some of it could be passive, they are holding it because they're in an index fund, etc. They tend to kind of go by what the proxy advisors say. So there are some proxy advisors whom we are who subscribe to our voting recommendations, but there are others who are taking the help of the global firms. So it's a mixed bag out there with the global firms.
Okay. Now coming to something, the inside story of IIAS. I mean, it's quite fascinating to know the sort of, in a matter of about a decade, you have set up this this particular company, and with having such a wide range of services to the corporate sector. Now, how do you, what is the source of information which you get? Of course, now that you have 50,000 resolutions, and so that's one aspect of the data mining which could happen substantially. It's a sort of archived. But in terms of, because you're looking at publicly available information, so what could be the sources of information? And subsequently, this is equally important, which is actually linked to the first one. First is about the sources. Second is about the resources. Now, in terms of manpower, in terms of intellectual capability to weave and analyze and interpret, what sort of who make this IIAS apart from the board and the management?
We've got
insight, because this is extremely important for us to know, because most of the work which is being sort of commented upon is actually the work of the company secretaries.
Sure. So look, we've got a mix of, the team is, we are 20 to 25 strong, depending on how you define it. I say 25 because there are people who are doing data entry who may not be, on our roles full time, or someone who are helping with technology, but they're kind of full time committed to working with us. So, depending on how you want to measure it, it would be. And it's a mix of people who've kind of, company secretaries, lawyers, chartered accountants, MBAs, etc. And we have a very robust process in terms of what we do is that, I mentioned that we have a committee process which kind of looks at each resolution. So what happens is that the entire office or the entire analytical staff participates in the discussion. So, I may not be, let's say, looking at a particular company, but if I'm taking part in the discussion, I kind of pick up what is happening. So that's a very, I'd say, a very robust way of passing on knowledge from one generation to the next, or from the older analysts to the younger, so that everyone kind of understands our philosophy and how we think about things. The other is, we speak to companies. I mean, other than the standard data sources, which is, website, news sources, dialing into conference calls, sell side research. We also, talk to investors. We talk to companies. We might talk to a competitor to understand, how do they view something which is happening. I'd just like to say that, when that was going on, we would have published about, we ourselves were a little bit kind of blindsided by what had happened. And therefore, how do you interpret events? How do you think about it? Is there some right or wrong, or is it all shades of gray? I would have personally, I mean, I'm not talking about others in the team, but I would have personally, over the course of those 2 or 3 months, spoken to about 70, I'd say about, 70 people is a reasonably accurate guess of, people who'd worked in the company, who continue to work there, who were on the board of the group, who had been on the board, who are suppliers, who are ex-TAS employees. And, you kind of keep speaking to everyone. And what happens is that, when you kind of talk to people, a picture emerges, you're able to connect the dots. And once you've got a picture, you can then start looking at data which either validates what your hypothesis is, or says that, look, your hypothesis is incorrect. And the same thing happened, when the whole Narayan Murthy, Vishal Sikka saga was on. So while we had our views, if you look at our commentary, it's not that we've taken sides. And sometimes we've said Narayan Murthy is right, and sometimes we've said, look, the board is right. So you have to kind of balance it out, because these are events which are unfolding. You don't have a final decision point. So therefore, it's how do you think about some of these things, which suddenly, the market might get very excited about, but they have very little bearing in terms of the underlying, how the company behaves, what they do, how are they moving things forward, what are the processes. So the good example is, when that whole whistleblower complaint in Infosys came, we believe that the company handled it very well. There was no need for the market to jump ahead and say, tell us, things have kind of gone awry, because the company had, and we kind of said that, look, we believe the company has done what is the right thing to do, and therefore we are supporting the company in what they're doing. Okay. So that is how we kind of do it. But as I said, look, it has to be talking to people. So even yesterday, I had a call with, there's a company we don't know very well. So we spoke to the investors. What do you think about the company? How they behaved in the past? Do you think, while these are the pluses and minuses of this decision, and this is how we are weighing in front, this is how we are weighing it based on these assumptions. Do you agree with our assumptions? So that's how you have to move these conversations forward.
Okay. Now there's the same the SEBI guideline for which is applicable from 1st of September. It carries a very curious guideline which says proxy advisors shall clearly disclose in their recommendations the legal requirement vis-a-vis higher standard they are suggesting, if any, and the rationale behind the recommendation of higher standards.
Yeah.
Now, how do you? This is something which is very fascinating, in the sense that how do you determine this particular issue, and the sort of standards which you have? Have you formulated any standards, or is it based on company to company, or is it based on situations? Because this is quite a challenging task as far as the proxy advisors are concerned. They will also be on some sort of a, of course, as you said very rightly, that these are all contextual and subject to various subjective situations. But nevertheless, that since we are talking of higher standards and they have mandated the proxy advisors to to sort of hold the resolutions or the companies to a higher standard, and they have made it mandatory that you disclose them. So this is quite an uphill task, if I may say so. Just a brief enlightenment would be a.
So I'll kind of address it in different ways. One is, as I mentioned, the question that, look, do we have, we try and anchor ourselves on a view and a way of looking at things. So all this is there in our voting recommendations. Over and above that, if you look at any of our voting advisory or proxy reports, what you'll find is there will be, each of them comes with, each resolution will come with a box which says what are the regulations and what is IIAS's standard. Now, you're right. In some instances, it is easy. Some instances, it's evolved. Our thinking has evolved over a period of time. So let me give you an example of the first. So, the issue was that, directors' independence. Now, let's say regulations. I mean, earlier, when you look at what CII committee, it actually said director should be six years. And then they were at 8 years. They changed it to 6 years before the Companies Act put it at 10 years. Now they put 10 years, saying that, look, 10 years kick in from 2000 and once the act has become effective. So it was some date in 2014. Our view is that, look, if you've been on the board from, 2003, you've got 11 years and then there's another 10 years. So if you've decided 10 years is 10, so let's stick to that 10 years and say that, if you've been on the board for more than 10 years, so we draw a very hard line on that. So that is one example of something which we believe needs to be done. I think the Companies Act, in a sense, should have approached it slightly differently. They should have kind of said that, look, people can, given 1 year or whatever, or said people can ride out their term. As their term gets over, the new ones, if anyone's been there for more than 10 years, should have gone out. But anyway, that's my view versus the view which the MCA will have. Another example is that, when you look at resolutions, and this is something which we've, it's a change which we brought about from this year, but we've been kind of talking about it, is that we find that oftentimes resolutions don't have a life, which means that they could be in perpetuity. Now, our issue in that was that, when we were talking, companies done something which kind of surprises you, we find, we speak to the company says, look, we kind of got this approved in a resolution about 4 years or 5 years back. So what we've started doing from this year is that the Companies Act doesn't say the resolution needs to have a tenure or a duration. But what we've started saying from this year is we expect that resolutions will have a shelf life, whether it's 3 years or 5 years, you define it, but we want a shelf life. And the reason we want a shelf life is that, look, your investors today are one set, but you might have a completely different slate of investors 3 years from now, 5 years from now. And therefore, those investors should also periodically get a chance to vote on your resolution. We kind of, while we've done it for all resolutions now, we started doing it for royalty resolutions last year. The other example of this is for related party transactions or others. We said that, look, you have to define, and this is, we were doing it before. We said you have to do two things. You have to tell the investors either what the duration is or what the cap is. You have to say that, look, these transactions, once I hit 1,000 crores, I'll come back to shareholders. Now, you could say that, look, this is not something which the Companies Act is saying. Why were we saying it? Because we were saying that, look, for it as an investor, you would want to know before you kind of give an approval to the company or sign off. You would want some clarity rather than saying it's an open-ended resolution. It's not telling me what the amount is. It's not telling me what the duration is. It's just saying, trust me. Now, so we had two choices. We said, look, either we say that, okay, these are the companies we trust and these are the companies we don't trust. And those we trust, we'll approve, and those we don't trust, we won't. But that is, as you can understand, an extremely slippery slope. And sometimes companies who you believe are well governed do something stupid, and there are many times when companies who are not so well governed continue to do the right thing. So we said, look, why not kind of put in these such kind of checks and balances in the first instance. And you would have seen in all these, these are resolutions which kind of get approved in the normal course of business. And therefore, we felt that, look, if the company gives a little bit of explanation, meets the investors, it's not a bad idea if there is a timeline which is put to a resolution. So this is one of the changes we've had, and these are just two examples of what we've done. Compensation is tricky. We don't, we do kind of try and, since it's very tricky, what we do try and do is ask for more and more information at each stage, and hoping that that brings some degree of clarity rather than being very so I would say that, there is a general degree of predictability about how we'll behave, other than on compensation, which, that different companies, different contexts, someone is kind of had a very rough, rough time. They can't do anything but hire at incredibly high salaries to help them turn around. Sometimes it's steady state, and therefore you wonder why someone is being paid so much. You can't say that the CEO will be paid 1% of profit, but not define what that 1% is. We saw that happen in HEG when the CEO was paid 1% of profit, meant the number was about 110 crores, which he unfortunately then took. The board didn't say that, look, 110 is too much. It should be, 30 crores or 20 crores or 10 crores. But he took the entire amount. Next year, when the profits fell, the cycle turned, they took home about 20 crores. Now, it had nothing to do with your ability. It just had to do with, so those are things where we kind of, give some pushback or put out our saying that, look, this is where our recommendations are different from what the Companies Act has said. But just one last thing, what we do more often than not is put these out for public comments so that investors, companies, lawyers, and people like yourselves have an occasion to respond to them, so that before we come up with our guidelines, we've kind of taken into account some of this feedback.
Okay. So now coming to probably a couple of more questions. This since you have an access to so much of resolutions, I mean, what has been what has been your general understanding? Whether have you noticed any substantial discrepancies, or what are your observations in terms of is it company specific, or is it situation specific, or is it you find most of the resolutions are I wouldn't say you have. I mean, I would repeat what you had said, cut and paste resolutions, or in that context.
So I'd say one of the things which we've started doing is we've kind of started tagging resolutions as good resolutions. So if you kind of go to our website, you'll get examples of good resolutions. I think the biggest challenge which we face is that oftentimes, companies come back and say, this is a legal opinion. And some of it might stem from lack of clarity in terms of the regulations themselves. So an example, again, something straightforward, which is top of mind because it kind of, we had a discussion on it yesterday, which is that, now you're supposed to give the auditor's fee as a part of the resolution itself. Now, someone kind of gives it, someone doesn't give it to say that it has to be given in the instance of the first appointment, not if someone is getting reappointed. Now, that is an example. So we find that one is the fact that since the regulations, and, we've kind of found that this happened. The big one was, what is, the tenure. And yesterday we had this discussion on a resolution where someone got appointed as an additional director in November, let's say November 9, November of 14 or 13, or whatever, let's say 13, and then they kind of got the board approved, the AGM approved their appointment in August. So they've taken an interpretation that the 2-year term or tenure is, effective date is August and not when the person was an additional director. These wisdom, which most other people do, is to say that, look, it's from when you got appointed, whether you're additional director or got approved at the AGM, and if it's continuation, it's continuation. So these are areas which we find that, there are certain interpretations which people have. What we do just now is we encourage companies that if you've sent out a notice and the postal, the e-voting has not begun, you can put out a clarification as long as it's in the explanatory note, not, to say this is my intent. Now, some companies have been doing so. Others are saying that, no, this is very cut and dry. We can't make any change neither to the notice nor to the explanatory note. So therefore, we are going to live with the consequences. So these are the areas where we find that there is some degree of, increasing back and forth, which happens. Now, over a period of time, we formed our view. And we've, again, for conversations like this, we speak to other, large companies, small companies, company secretaries, legal people to form our view. I would say that, if you speak to 5 people, there are 6 opinions. But as I mentioned earlier, some kind of loose parameters kind of emerge out of it. And so we take a stance. It may be which we believe is right. And more importantly, we are guided that, look, is this, how is it from an investor perspective? Is it giving them more clarity? Is it in some ways what we believe is inimical to their interests? So that's how we get guided.
Okay. Now there's
you yourself, I'm sure if we ask people in this room, there'll be different opinions on the same resolution in terms of how they see it and how they interpret it, and where's the comma placed and where's the full stop, and if it had another comma rather than a full stop, that would be the interpretation. So unfortunately, we have to live with this.
Yes, but then you said you're looking for that common thread, which will give you some amount of insight into what the intentions are. Now, may I ask you another question, which is quite, which has been quite intriguing. How do you choose companies? Is it based on what the institutional shareholders want you to do, or is it based on a random basis? Or
no, we don't. When we started, we began with 200 companies and very quickly included all the F&O companies. So that was about 280 on the assumption that, look, they're more likely to be owned by more investors than less. And then we started with these 280 companies and went out and, so I go and meet, let's say, I'm just making a name, SBI. SBI says that, look, we have an investment in 350 companies. So we said, okay, you give us the list and we'll start tracking 350 companies. Then with the 350, we went to the next one. So let's say we go to DSP. DSP says, look, I have an investment in while it's 200 companies, there are 25 companies which you don't cover. So we say, okay, give it to us. We'll start covering those companies. So based on this, we are now at, I would say, my BD team tells me that we are now at close to 900 companies. And in the aggregate, we would have looked at 1100. So we may have been tracking a company, but investors, no one owns it today. So we don't track it. We've looked at about 1,100 companies, but today we have about, I would say, close to 900 companies which we track. So we've kind of kept ourselves out of the equation. It's what my customers want.
Okay. And what generally is the business model? It's based on what the investors, the subscription model.
It's a subscription model. So you tell me whether you want recommendations on 25, 250, 750 companies, and we kind of charge on that basis. So it's per company, not on per meeting.
Okay. And then is it also, this particular thing is also available for non-institutional shareholders?
Sure. So there are two things which are there, which is, if you go to, again, IIAS Adrian, you can download reports, you can download the full report. There's a small payment, or you can go to our Twitter feed, where I'd like to believe we are, unfortunately during the season, we don't do it, but all voting recommendations, you'll get whether we are recommending for or against, you get. You don't get the rationale. You need to download the rationale, which is available on IIS Adrian or on our website. You pay for it and on our website. You can get it pay for it and get it on our website, or get it on our website and pay for it. The other way around.
Okay, so that of course I have seen in the Twitter which I am following, both IIAS and you.
So if you follow that link, you can actually, that enables you to buy the report.
Okay. It's very, I must say, I have more or less covered most of the queries which I have had.
So I think there was just one or two questions. If you're there, they say there's a difference in view in Proxy Advisors on the same issue. This is as I say that, first is there's a difference, a little bit of difference in approach. So when I kind of look at, the raw data, we kind of, last year, let's say we voted against about 10 or 11%, and our number is around that. Some others in the market are against 22%. It's a difference of approach. So one is you can take a little bit more compliance approach. The other is to take a little bit more pragmatic approach to say that, look, this is within some, as I said, let's say, if you've not declared the fee which you're going to pay the auditor, we kind of flag it off and say they should have disclosed it and get on with it, saying that, look, you can't, the consequences of voting down an auditor are more severe than not having an auditor, and therefore, we kind of say, let's get on with it. Someone might say that, look, you should have disclosed the fees, you've not disclosed it, so we are voting against. So you kind of find that that's one of the reasons of the differences. The second is, it could be philosophically. So the big case which kind of dominated the headlines was PNB housing. We were for the transaction. One of our domestic competitors was against it. Their view was that, you haven't got a valuation report, and that is critical. Our view was that, look, there are bigger problems for the company to juice over. Our other view was that, look, there is a market. Market has formed a view and determined the price, which should, for all practical purposes, be the driving force. And, I just, between us, I find SEBI's stance. SEBI could kind of call them up or penalize them, or that's more for the MCA. But for SEBI to say that, look, we will go by a report of a valuer rather than what the market price is throwing up, which is, and we are responsible for the market and we should therefore be driven by the market price, is something which I can't understand. But anyway, they've taken a very hard line on it. So this is another example of a difference between different proxy firms. But we are used to it. So if you kind of think about it, different brokerages, some have a buy, some have a sell. They have a different perspective. You look at rating agencies, they're all not at the same rating. So ours is also, in that sense, it's akin to what has happened.
Okay. There's another query which has come. As a proxy advisor, have you taken a neutral stance on any resolution? If so, what are the circumstances?
So look, till this year, we were not giving a recommendation on the approval of accounts, but SEBI then put out a notification saying all funds should vote on all resolutions. So what it meant was that we had to kind of give a recommendation. I kind of, I'll kind of just go into a little bit of a history. So when we kind of started out in 2000 and we put together our first recommendation in 2011, it was for CIPLA. And BSE was a large shareholder. So BSE said, look, as soon as you get your first report, we want to share it with our board. And in that recommendation, we had an abstain. And we this wasn't on the accounts, but it was for one of the director appointments. So when we sent it to BSE, Keki, who was on the board of, from HDFC, who was on the board of BSE, gave a feedback saying that, look, if I'm going to pay you, I want you to tell me for or against. He said, I don't need you to tell me to abstain. So after that, we've kind of voted for or against. The few instances where we abstain is a little bit technical, which is on bank director appointments, where it's a very truncated process where they say we are appointing a director, someone gives the name, then the names are not there. So how do you recommend if there are no names for appointing a director? So we just kind of withhold our recommendations, so to speak, till the names are available, at which point, if there are two vacancies and only two people have applied, then both of them get elected. So those are a little bit of technical variations where we don't. But from this year, we've started voting on all recommendations, on all resolutions which are put to shareholders to vote.
There's one more query which has come.
And let me just add that if there's not enough information, we'll vote against. Okay. So if we feel there's no enough information for us to take a view, including director appointment to, we often say that, look, he's eminently qualified. He's worked in a consultancy and in financial services. That doesn't tell me anything. So we'd say, look, we don't know where the person has worked, whether he's got sufficient experience, not sufficient experience, were they with good NBFCs, bad NBFCs. So we'll kind of vote against if there's not sufficient information.
So that's going to be very interesting after 1st of January, I'm sure. Now probably, as happened in the case of one marquee director, he could get through thanks to non-institutional shareholders and promoters. But I think after 1st January, it's going to be tough. So
there's another question on Vedanta. So our reason for, the view we've taken is we are not the subject experts on accounts. And therefore, if the accounts are qualified, we will vote against on the accounts. So the question is, why were you voting for the auditor, though you voted against the accounts? We voted against the accounts because they're qualified. I guess that's pretty much the reason why we voted for the auditor.
Okay. If there are any further questions from my end, I think I have whatever I have chalked out, and it's been there going on for about 1.5 hours. This was been quite an engaging session morning. I must thank Amit Tandon wholeheartedly for having brought in substantial clarity to the understanding the role of proxy advisors. And as I mentioned in the opening remarks, that no wonder that proxy advisors have, I don't want to use the phrase slowly but surely, they have emerged as the governance guardian.
Thank you very much. What I've done is, for the benefit of everyone, I've kind of just given the name IIAS-Adrian.com. You can all register. I think what it enables you to do is, for 1 week, you can play around on the website. It kind of gives you, as you kept saying, that 50,000. I don't think there's any other website or any other source which will give you such a wealth of information. So I think it's just available to any of you to play around with and get a sense of what it is. And the subscription also, if you just want to look at on this part of it, is also very, very, I might say, competitively priced. So it's less than 2,000 rupees a month, or less than 1,500 rupees a month for that matter. So you can all, whoever wants it. Sorry, I'm doing this plug for my website, but I'm doing it not because I believe it's going to add value to all of you who might have dialed in for the call today. So this is why I'm talking about it. And I thank you, sir, for giving me the opportunity to come and talk to you about this subject, which, as I said right at the beginning, I feel very passionately about. So, if there's any other, I'd say that, look, if there's any other follow-up question or someone has needs any other clarifications, please feel free to just forward it to me and I'll kind of send a response to this.
One more request, if you can forward your presentation, that would be
Sure.
Grateful.
Sure, I'll do that. I'll do that.
For any of you, any of those who would like to go through your presentation, which is extremely interesting and insightful. Thank you, Amit, and thank you, viewers, for having been with us today morning. And in fact, as Mr. Tandon mentioned, before we commence the program, that it was quite intriguing as to know more about the proxy advisors who have been playing a very, very significant role in the governance ecosystem. So we in SAGE thought that we should devote substantial time to understand what their role is, their processes are, their methodology, and the persons to whom they serve. Because we as company secretaries, we are at the back end of the processes which proxy advisors analyze. So it would also be equally interesting for us to learn, probably learn, unlearn, learn and relearn, so as to make our job much more effective and efficacious. Thank you so much for being with us. Thank you.
Bye-bye. Bye-bye.